If you're a senior filing taxes in 2026, the CRA just changed the rules and it could cost you thousands of dollars if you don't know what's happening. I'm talking about real money coming out of your pocket or missing benefits you're entitled to. In the next few minutes, I'm going to walk you through every single change that affects you, your pension, your OAS, your GIS, and show you exactly what you need to do before the April deadline. Stay with me because change number 4 could literally save you over $3,000 this year alone. The Canada Revenue Agency doesn't make changes just for the sake of it. Every adjustment they make to the tax system has a ripple effect on your financial life, especially when you're living on a fixed income. Whether you're receiving old age security, the Guaranteed Income Supplement CPP, or pension income from your years of hard work, these new rules for 2026 will touch every part of your tax return. I want you to understand something clearly. You worked your entire life. You paid your taxes. You contributed to this country. And now in your retirement years, you deserve to keep every dollar you're entitled to. But here's the reality. The CRA estimates that seniors leave over $2 billion on the table every single year because they don't know about credits, deductions, and benefits they qualify for. We're going to make sure you're not part of that statistic. The first major change for 2026 involves pension income splitting. And this is huge for couples. If you're married or in a common law relationship, you've probably been splitting your pension income to reduce your overall tax burden. This strategy has saved Canadian couples millions of dollars over the years. Here's what's new. The CRA has modified the rules around which types of income qualify for pension splitting, and they've also changed the reporting requirements. Previously, any pension income from a registered pension plan could be split 50-50 with your spouse if you were both over 65. That basic rule still applies, but now there are specific conditions around RRIF withdrawals for those under 71. Say you're receiving $40,000 from your company pension and your spouse has minimal income. Under the old rules, you could split that pension, each claiming $20,000. This moved you into a lower tax bracket and potentially protected your OAS from clawback. The new rules still allow this, but you now need to file a specific form called the TPO 32 joint election to split pension income before a deadline that's earlier than it used to be. Here's the part that could cost you money. If you miss this filing deadline, you cannot split your pension income for that tax year. There are no extensions. There are no second chances. And for a couple where one spouse is in a high tax bracket, this could mean paying an extra $3,000 to $5,000 in taxes. What you need to do if you're splitting pension income, mark February 15th on your calendar. That's the new deadline for filing your T132 form. Don't wait until you file your taxes in April. The CRA wants this form earlier, and if you're working with an accountant, make sure they know about this deadline change. If you file your own taxes, you can submit this form online through My Account, or you can mail it to your tax center. Just don't wait. Now, this second change might not seem like it affects you at first, but trust me, it does. Canada introduced a digital services tax that impacts large corporations, but the ripple effect reaches your investment income and your dividend payments. If you have investments outside your TFSA or RRSP, if you own stocks, mutual funds, or ETFs in a regular investment account, you're receiving dividend income and capital gains. The new digital services tax has caused some companies to adjust their dividend payments. And more importantly, it's changed how foreign investment income is reported on your T5 slips. Here's the real impact. Many seniors have investments in U.S. stocks or international funds. When you receive dividends from these investments, you normally get a foreign tax credit for any U.S. taxes withheld. The new rules have tightened up the documentation requirements for claiming these credits. If your T5 slip doesn't show the foreign tax paid in the correct box, you might not get the full credit you deserve. Say you have $50,000 invested in U.S. dividend stocks, and they pay you a 3% dividend. That's $1,500 in annual income. The U.S. typically withholds 15% tax, which is $225. Under the old system, claiming that foreign tax credit was straightforward. Under the new system, if your documentation isn't perfect, you could lose that credit and end up paying Canadian tax on the full $1,500 without any credit for what you already paid to the U.S. What you need to do when you receive your T5 slips this year, check box 15 for foreign income and box 16 for foreign tax paid. Make sure both boxes have amounts if you received foreign dividends. If they're blank, but you know you received foreign income, contact your financial institution immediately. They need to issue a corrected T5. And when you file your taxes, make sure you're claiming the foreign tax credit on line 45 of your return. This is money you already paid to another country. You're entitled to get credit for it. Before I continue with the next changes, if this information is helping you understand how these new rules affect your money, do me a favor and hit that subscribe button right now. I make these videos every week to help seniors like you keep more of your hard-earned money and navigate the CRA's complex rules. Subscribing is free, and it makes sure you don't miss updates that could save you thousands of dollars. Okay, let's keep going because the next change is critical for anyone receiving old age security. Old age security is a cornerstone of retirement income for most Canadian seniors. If you're 65 or older, you're probably receiving it. But there's always been a catch. If your income is too high, the government starts taking back your OAS through something called the OAS recovery tax, or as most people call it, the clawback. Every year, the clawback threshold is supposed to be indexed to inflation. For 2026, the threshold has been adjusted. But here's what's different. The CRA has changed how they calculate what income counts toward this threshold, particularly for seniors who are still working part-time or earning self-employment income. The current threshold sits at approximately $86,000. Once your net world income exceeds this amount, you start losing 15 cents of OAS for every dollar over the threshold. If you're making around $142,000 or more, you lose your OAS completely. Here's the new wrinkle for 2026. The CRA is now including certain types of income that were previously excluded from the calculation. Specifically, if you're earning income from rental properties and you're claiming CCA depreciation, that depreciation recapture is now being counted toward your OAS clawback threshold. This is a significant change for seniors who own rental properties as part of their retirement income strategy. Let's look at an example. You're receiving OAS of $7,000 per year. Your pension income is $60,000. You own a rental property that generates $15,000 in rental income after expenses. Under the old rules, you're at $75,000 in income, well below the clawback threshold. You keep your full OAS. But now, if you've been claiming depreciation on that rental property and you sell it, or if the CRA recalculates your rental income with the new rules, that recaptured depreciation gets added to your income. Suddenly, you could be pushed over the threshold and you start losing your OAS. For someone right on the edge of that $86,000 threshold, this could mean losing over $1,000 in OAS benefits. What you need to do if you own rental properties, talk to a tax professional about whether claiming CCA is still beneficial under these new rules. Sometimes it's better to not claim depreciation and keep your income below the OAS threshold. Run the numbers both ways. And if you're close to the threshold, look at income splitting strategies with your spouse, or consider moving investments into your TFSA, where the growth in income won't count toward the clawback calculation. Now, here's some good news. This is the change I mentioned at the beginning that could save you over $3,000. The CRA has significantly expanded what qualifies as a medical expense for the medical expense tax credit. And they've also changed the rules around when you can claim these expenses. For years, seniors have been able to claim obvious medical expenses, prescription medications, dental work, eyeglasses, hearing aids. But the 2026 changes have added several new categories that are particularly relevant to seniors, and many of you don't know these are now eligible. Here's what's new. Home accessibility renovations that were previously only eligible under the Home Accessibility Tax Credit can now also be claimed as medical expenses if they're prescribed by a medical practitioner. This includes things like walk-in bathtubs, stair lifts, wheelchair ramps, and widened doorways. The difference is significant because the medical expense tax credit can be worth more than the home accessibility credit depending on your income level. But it gets better. The CRA has also expanded the list to include certain technology devices and services. If you have a chronic condition that requires monitoring devices like continuous glucose monitors, blood pressure monitors, and even certain medical alert systems now qualify. Are you leaving thousands of dollars on the table? The 2026 changes to medical tax credits are here, and they could mean a massive refund for you. Rehabilitation therapy from licensed practitioners, including physiotherapy and occupational therapy, are now explicitly listed as eligible. And here's the big one. The rules for attendant care or nursing home care have been clarified. You can now claim both attendant care and the disability tax credit. Let me show you the money. Impact. These changes aren't just technical. They're worth real dollars in your pocket. Say you spent $5,000 on dental work and $2,000 on prescription medications this year. Add $3,000 for physiotherapy and $8,000 for a doctor-recommended walk-in tub. That's $18,000 total. After the 3% threshold, you're claiming $16,000 at a 20% tax rate. That's a tax savings of $3,200. What you need to do? Start keeping receipts for everything health-related. This is critical for your 2026 filing. Get a letter from your doctor for medical home renovations. It must state the renovation is necessary due to your medical condition. And here's a pro tip. You can claim medical expenses for any 12-month period ending in the tax year to maximize your credit. If you receive the Guaranteed Income Supplement, this change is critical. Your GIS is based on your net income from the previous year. Need help? Call Service Canada at 1-800-277-9914. Try calling MIDM morning midweek for the shortest wait times. Stay proactive. You've earned these benefits. Subscribe and click the bell for weekly updates on maximizing your Canadian senior benefits. The amount you receive can make the difference between financial security and struggling to pay your bills. The CRA has changed the reporting requirements for GIS, and they've also modified what income is included and excluded from the calculation. This is important because even a small change in your reported income can affect your GIS payment by hundreds of dollars per month. Here's what's new. The CRA is now automatically calculating GIS eligibility for most seniors based on your tax return. You don't need to apply separately each year if you're already receiving it. That sounds convenient, but here's the catch. If the CRA's calculation is based on incorrect or incomplete information, your GIS could be reduced or cut off, and you might not realize it until the money stops coming. The bigger change involves what income is excluded from the GIS calculation. Certain types of income don't count toward GIS, like the first $5,000 of employment income. Compensation from a provincial or territorial government for a declared emergency or disaster, and specific Indigenous income. For 2026, the CRA has clarified and expanded some of these exclusions, but they've also tightened rules around RRIF withdrawals and how they affect GIS. Here's a situation that affects many seniors. You're 72 years old receiving GIS, and you have a small RRIF that you're required to withdraw from. Those mandatory RRIF withdrawals count as income for GIS purposes. What many seniors don't realize is that if you have a spouse and one of you is under 65, there are strategies to minimize how those withdrawals affect your combined GIS. The real impact on your pocket GIS can be worth up to $12,000 per year for a single senior or over $15,000 for a couple. If a change in how your income is calculated reduces your GIS by even 20%, you're losing $2,000 to $3,000 annually. For someone living on a tight budget, that's devastating. What you need to do, file your taxes on time every single year, even if you have no income. The CRA can't calculate your GIS if they don't have a current tax return. If you're receiving income that you believe should be excluded from GIS calculation, make sure it's properly coded on your tax return. Indigenous income should be on line 10 of Form T90. Emergency assistance should be properly documented. And if your GIS amount changes and you don't understand why, call Service Canada immediately and ask for an explanation of how your income was calculated. And if your GIS amount changes and you don't understand why, call Service Canada immediately and ask for an explanation of how your income was calculated. This change affects seniors who are still working. Yes, you can collect CPP and still work. But if you're under 70 and still earning employment income, you're making CPP contributions. The rules around these contributions have changed for 2026. Canada has been implementing the CPP Enhancement Plan for several years. This plan increases how much you and your employer contribute to CPP with the goal of providing higher retirement benefits in the future. For 2026, the contribution rates have increased again, and the earnings ceiling has been raised. Here's what this means for you. If you're 66 years old, receiving CPP and working part-time, earning $20,000 per year, you're now paying a higher percentage of that income into additional CPP contributions. These are called post-retirement benefits, or PRB. Every year you contribute, you get a small increase to your CPP payment the following year. But here's the question you need to ask. Is it worth it? The increased contributions mean less money in your pocket right now. For 2026, the contribution rate is approximately 6% of your earnings split between you and your employer. If you're self-employed, you pay the full 12% yourself. On $20,000 of earnings, that's $200 if you're employed, or $2,400 if you're self-employed. The post-retirement benefit you receive in return is calculated as 150th of your contributions adjusted. For most seniors, that translates to an extra $20 to $30 per month added to your CPP for each year you contribute. If you contributed $200 and you get an extra $25 per month, that's $300 per year. It will take you 4 years just to break even. Here's the change for 2026. You now have the option to elect to stop contributing to CPP if you're receiving a CPP retirement pension and you're under 70 Previously, this election was complicated, and many employers didn't process it correctly. The CRA has streamlined the form and the process. What you need to do if you're working and receiving CPP, decide whether you want to keep contributing. If you're in your late 60s and in good health, continuing to contribute might make sense for the long-term benefit increase. But if you need that money now, or if you're 70 or older, you can elect to stop contributing. Fill out Form CPT 30 and give it to your employer. If you're self-employed, you make the election on your tax return. Just understand that once you stop contributing, you won't receive any more post-retirement benefit increases. The disability tax credit is one of the most valuable tax credits available, worth over $8,000, but it's also one of the most underutilized by seniors. Many people think you need to be severely disabled to qualify, but that's not true. The eligibility criteria have been expanded for 2026, and more seniors now qualify than ever before. Here's what's changed. The CRA has broadened the interpretation of what constitutes a severe and prolonged impairment. Specifically, they've added clearer guidelines around cumulative effects. This means if you have multiple conditions that individually might not qualify you, but together they significantly restrict your daily activities, you may now be eligible. For seniors, this is huge. Maybe you have arthritis that makes walking difficult, hearing loss that affects communication, and vision problems. Subscribe for more updates and contact Service Canada at 1-800-2779-914 for help. But combined, they could qualify you for the DTC. The 2026 guidelines now explicitly state that medical practitioners should consider the cumulative effect of multiple impairments. Additionally, the rules around life-sustaining therapy have been clarified. If you need to take medication or do therapy at least 3 times per week, averaging at least 14 hours per week, this can qualify you. For many seniors with diabetes who need to monitor blood sugar, insulin therapy, meal planning, and foot care can easily add up to 14 hours weekly. The financial impact is substantial. The disability tax credit itself is worth over $8,000, which at a 20% tax rate saves you $1,600. But it gets better. If you qualify for the DTC, you also become eligible for the Registered Disability Savings Plan, additional medical expense claim rules, and the Canada Caregiver Credit if someone is taking care of you. And here's something many seniors don't know. You can apply for the DTC retroactively. If you've had your condition for years but never applied, you can go back up to 10 years and claim the credit for all those years. That could be $16,000 in tax refunds. What you need to do, talk to your doctor about whether you qualify. Don't be shy about this. If you have mobility issues, chronic pain, mental health conditions, or any impairment that restricts your daily living activities, ask your doctor to fill out Form T2201. The worst that can happen is the CRA says no, but if they say yes, you could receive thousands of dollars in retroactive refunds, plus ongoing tax savings for the rest of your life. We've covered 7 major changes that affect how you file your taxes in 2026. Every one of these changes has the potential to either save you money or cost you money, depending on whether you know about them and take action. Let me remind you of the key dates you cannot miss. February 15th is the new deadline for pension income splitting elections. April 30th is the deadline for most people to file their taxes. But if you or your spouse is self-employed, you have until June 15th to file, though any taxes owing are still due April 30th. And throughout the year, keep collecting those medical expense receipts and documentation for any credits you plan to claim. If you found this information valuable, if you learned something that's going to save you money or help you keep more of your benefits, I need you to do two things. First, subscribe to this channel right now so you don't miss future updates about CRA changes, tax strategies, and benefit programs for seniors. Second, share this video with other seniors in your life, your friends, your family members, people in your community who might not know about these changes. We need to make sure every senior in Canada knows their rights and keeps the money they're entitled to. Remember, you worked hard for decades. You paid your taxes. You built this country. The CRA has rules and programs designed to help you in retirement, but they're not always easy to understand. That's why I'm here breaking down these complex changes into simple, actionable information that you can use to protect your financial security. Don't leave money on the table. Don't miss deadlines. Don't assume that the CRA will automatically give you everything you're entitled to. You need to know the rules, claim what's yours, and file correctly. These 7 changes for 2026 are just the beginning. Tax laws change every year, and I'll be here to guide you through each one. Take action today. Review your situation against each of these 7 changes. Talk to your tax preparer if you use one, and make sure they know about these updates. If you file your own taxes, mark those deadlines on your calendar right now, and most importantly, don't be afraid to ask questions. Call the CRA if you're unsure about something. Call Service Canada about your benefits. Get the answers you need to make informed decisions about your money. Your retirement should be a time of peace and security, not stress about taxes and forms and deadlines. With the right knowledge and preparation, you can navigate these changes confidently and keep every dollar you've earned and every benefit you deserve. I'll see you in the next video, where we'll dive even deeper into tax strategies that save seniors.